Right now, everything looks fine. Markets are near all-time highs. Headlines talk about resilience. Economists speak confidently about soft landings, controlled inflation, and a future that's finally back on track. If you're only looking at the surface, it feels like the storm everyone warned about never came. But that's exactly the problem. Because every major financial crisis in modern history shared one dangerous feature: a moment of calm so convincing that most people stopped paying attention. Not because the risks disappeared, but because they were hidden, delayed, and pushed out of sight. In 1929, the market was celebrating record highs just months before it collapsed. In 2007, banks were reporting record profits while quietly loading the system with toxic risk. And today we're watching that same pattern repeat itself, almost perfectly. The crash everyone expected for 2025 didn't arrive on schedule. And many people are taking that as proof that the system is safe, that the warnings were exaggerated, that the danger has passed. It hasn't. The delay isn't a sign of stability. It's a sign of pressure building underneath the surface. Because while the public is being told that everything is under control, the people with the best data, the deepest access, and the most to lose are behaving very differently. They're not celebrating. They're not expanding risk. They're not acting like this is a healthy, stable environment. They're preparing. And that contradiction, between what is being said and what is actually being done, is where the real story begins. This isn't about panic. It's about pattern recognition. When markets rise while fundamentals weaken. When confidence is broadcast while exposure is quietly reduced. When reassurance is loud but actions are defensive. History tells us something is wrong. Today the U.S. financial system looks strong on the outside. But beneath that appearance is a structure that has become more leveraged, more interconnected, and more fragile than at any point in modern history. Risk didn't disappear after the last crisis. It migrated. It moved into places most people don't watch. Into systems that operate without transparency. Into assets that can't easily be repriced, refinanced, or exited. And now those risks are converging. In this series, we're going to break down what's really happening behind the optimism. Why the biggest players are positioning for disruption. And why the absence of a crisis, so far, may be the most dangerous signal of all. Because when this system finally breaks, it won't unwind slowly. It will snap. And by the time it becomes obvious, it will already be too late to react. When people want to understand where the economy is heading, they usually listen to what leaders say. But history shows that the real signal isn't in the words. It's in the behavior. Because when risk is coming, smart money doesn't make speeches. It changes position. And right now, the behavior of the most powerful financial actors in America is flashing warning signs that are impossible to ignore, if you know where to look. Warren Buffett is holding an unprecedented amount of cash. Hundreds of billions of dollars sitting on the sidelines. Not invested. Not deployed. Waiting. That's not optimism. That's caution at the highest level. At the same time, top banking executives, the very people publicly assuring investors that the system is sound, have been quietly selling their own shares. Not buying. Not holding. Selling. For many of them, this is the first time in their careers they've done so at scale. And that creates a question no one on mainstream financial television wants to ask. Why would insiders reduce exposure to the institutions they claim are strong? This isn't random. And it isn't emotional. Executives don't sell stock because they're nervous. They sell because they see the numbers before everyone else does. They see loan performance before it shows up in earnings. They see liquidity stress before it reaches headlines. They see where profits are weakening, where risk is accumulating, and where the cracks are starting to form. Publicly, confidence is the message. Privately, protection is the strategy. This divergence between narrative and action is one of the most reliable signals of systemic trouble. And it's growing wider by the month. Economic growth is slowing. Margins are tightening. Interest rate cuts, once framed as relief, are now eroding bank profitability. And while the headlines frame this as a controlled transition, the internal adjustments tell a different story. Capital is being pulled back. Exposure is being reduced. Liquidity is being preserved. Not because everything is fine, but because it isn't. The most dangerous phase of any financial cycle is the moment when reassurance becomes a requirement. When stability has to be defended with words instead of reinforced by fundamentals. That's the phase we're in now. And while the public debate focuses on inflation, rate cuts, and soft landings, the largest risks in the system aren't being discussed at all. They're not visible on balance sheets. They don't show up cleanly in earnings reports. And they don't fit into simple economic narratives. They exist in the shadows. In the next part, we're going to look at the first and largest of those hidden threats. A parallel financial system that has grown quietly for years, operates with minimal oversight, and now holds the kind of risk that can destabilize the entire economy. The shadow banking system. And once you understand how deeply traditional banks are tied to it, you'll see why the calm we're experiencing right now isn't reassuring. It's alarming. After the 2008 financial crisis, the promise was clear. Never again. Governments passed sweeping regulations. Banks were placed under tighter supervision. Capital requirements were raised. Stress tests became routine. On paper, the system was safer. And in one sense, it was. But risk doesn't disappear when you regulate it. It adapts. What actually happened after 2008 wasn't the elimination of systemic risk. It was its relocation. Out of the traditional banking system, and into a parallel financial universe that operates with far less transparency. This is the shadow banking system. Private credit funds. Non-bank lenders. Structured investment vehicles. Financial intermediaries that look harmless on the surface, but collectively now control tens of trillions of dollars in assets. Globally, shadow banking has grown to a scale that rivals, and in some cases exceeds, the traditional banking system itself. And the most unsettling part isn't its size. It's who's funding it. Despite the narrative that banks became more conservative after 2008, they didn't retreat from risk. They simply found a new way to access it. By lending to lenders. Traditional banks are now deeply entangled with shadow banks through credit lines, guarantees, and off-balance sheet commitments. Instead of making risky loans directly, they finance entities that do it for them. This creates distance. It creates deniability. And it creates the illusion of safety. But economically, the risk never left the system. It multiplied. Because when banks fund shadow lenders, they absorb the downside without maintaining direct control over underwriting standards, borrower quality, or asset transparency. It's leverage layered on top of leverage, wrapped in complexity. These exposures don't show up cleanly on balance sheets. They don't trigger alarms during routine stress tests. And even regulators admit they don't have a complete picture of how interconnected this web has become. That's what makes it dangerous. In a stable environment, this system appears efficient, profitable, innovative. In a stressed environment, it becomes a transmission mechanism, spreading losses faster than anyone can contain them. When borrowers default in the shadow system, the losses don't stay there. They travel back to the banks that funded it, to the insurers that invested in it, to the pension funds that relied on its yields. And because so much of this exposure is indirect and opaque, it doesn't unravel gradually. It surfaces all at once. This is not theoretical risk. It's structural. A system built on hidden leverage doesn't fail slowly. It fails suddenly, when confidence breaks and liquidity disappears. And the shadow banking system doesn't exist in isolation. It's directly connected to the next pressure point, one that is fully visible, numerically undeniable, and approaching its moment of truth. Commercial real estate. In the next part, we'll look at why hundreds of billions of dollars in commercial property debt are becoming impossible to refinance, and why that problem is about to hit the weakest parts of the banking system first. There is a problem in the financial system that isn't hidden. It's not theoretical. It's not abstract. And it's not coming someday in the distant future. It's scheduled. In the coming period, an enormous volume of commercial real estate debt is reaching maturity. Office buildings, retail centers, mixed-use properties, all financed in a very different interest rate environment, now need to be refinanced in a world that no longer exists. And that's where the mathematics turn brutal. Property values have declined sharply as interest rates rose. At the same time, borrowing costs have surged. The result is simple but devastating. Many properties are now worth less than the debt attached to them. For refinancing to happen, owners would need to inject massive amounts of new equity, often tens of millions of dollars per property, just to roll their loans forward. For many, that makes no economic sense. When the value of a building is lower than the mortgage, default isn't a failure. It's a rational decision. And we're already seeing it happen. Major institutional owners have begun walking away from properties, not because they're insolvent, but because the numbers no longer work. Payments stop. Keys are handed back. Losses move from paper to reality. This wave isn't evenly distributed. The largest banks can absorb some of the damage. They're diversified. They have capital buffers. They have access to liquidity. Regional and community banks do not. These institutions hold a disproportionate share of commercial real estate debt. In many cases, these loans represent a staggering percentage of their total assets. When even a small portion of those loans sour, the impact isn't manageable, it's existential. And here's the most dangerous part. Banks know this. That's why many have been quietly extending loans rather than resolving them. Maturity dates are pushed forward. Terms are adjusted. Losses are delayed. This strategy has a name: extend and pretend. It creates the appearance of stability while the underlying problem continues to grow. But time doesn't heal a negative equity position. It deepens it. When these loans finally mature, and refinancing is no longer possible, the reckoning won't be gradual. It will be forced. Defaults will accelerate. Asset values will reset. And balance sheets that looked stable will suddenly reveal massive holes. This dynamic should feel familiar. It mirrors what happened during recent bank failures, not driven by credit losses at first, but by concentrated exposure and interest rate risk. Once confidence breaks, events move faster than institutions can respond. Now imagine that scenario playing out across dozens, or hundreds, of regional banks at the same time. And remember, commercial real estate isn't an isolated risk. It's tightly linked to the shadow banking system, to private credit funds, to insurers and pension funds searching for yield. Which means the losses don't stop where they begin. They spread. In the next part, we'll connect these threads, and show why the real danger isn't any single sector, but the way all of these risks feed into each other at once. The greatest threat to the financial system isn't any single problem. Not shadow banking. Not commercial real estate. Not regional banks. It's what happens when all of them collide. Modern finance is built on interconnection. Banks fund private credit. Private credit funds finance real assets. Insurance companies and pension funds provide capital to both. Everyone is linked through shared exposures, shared investors, and shared assumptions about stability. In good times, this web amplifies returns. In bad times, it amplifies losses. When commercial real estate values fall, private credit funds take hits. When those funds struggle, they can't meet obligations to the banks that financed them. Those banks then face losses that were never visible on their balance sheets to begin with. At the same time, insurers and pension funds, heavily invested in both real estate and private credit, face liquidity pressure. To raise cash, they sell other assets. Stocks, bonds, anything with a market. That selling pushes prices down elsewhere, triggering margin calls, redemptions, and forced liquidations across the system. This is how localized stress becomes systemic collapse. Not slowly, not sequentially, but all at once. The danger is compounded by opacity. No single institution has a full picture of the network. No regulator can map the entire chain of exposure in real time. And when confidence breaks, transparency disappears even faster. This isn't speculation. We've seen versions of this dynamic before. But today's system is larger, more leveraged, and far more complex than it was in 2008. Risk hasn't been reduced, it's been distributed in ways that make containment almost impossible. And that's why the current calm is so misleading. Markets are rising. Volatility is low. Optimism is being repeated until it feels like fact. But beneath that surface, the structure is tightening. Pressure is building in places most people never look. In commitments instead of loans. In guarantees instead of assets. In correlations instead of headlines. This is why the delay of a crisis isn't reassuring. It's dangerous. Because the longer these imbalances persist, the more violent the adjustment becomes when it finally arrives. And the people who understand this best are not waiting for confirmation from the news. They're already positioned. In the final part, we'll step back and ask the only question that really matters now. What does this mean for everyone else? And what should you be paying attention to before the window to act closes? At this point, the question is no longer whether the system is under strain. It is. The real question is whether you believe the story being told, or the behavior being shown. Because the most important signals in finance rarely come from press conferences or earnings calls. They come from positioning. From capital flows. From what powerful institutions do when they think no one is watching. And right now the message is clear. Record amounts of cash are being held on the sidelines. Insiders are reducing exposure, not increasing it. Risk is being quietly transferred, delayed, and obscured, not resolved. This is not confidence. This is preparation. The absence of an immediate crisis has created a dangerous illusion. Many now believe the threat has passed. That the warnings were overblown. That the system absorbed the shock and moved on. But delays in financial systems don't erase consequences. They concentrate them. Every month that refinancing is postponed. Every quarter that losses are hidden. Every reassurance that replaces action. The eventual adjustment becomes sharper, faster, and more destructive. When this system breaks, it won't unwind the way people expect. There will be no long countdown. No gradual decline that allows everyone to adjust. It will happen when liquidity disappears and trust evaporates, and by then the narrative will change overnight. Those who prepared won't be surprised. Those who believe the calm will be. This is why following the money matters more than following the headlines. The people with the most access, the most data, and the most to lose are not acting like everything is fine. They're acting like they've seen this movie before. And history shows that when smart money moves early, it's not out of fear, it's out of understanding. Understanding how leverage works, how interconnected systems fail, and how quickly stability turns into chaos when confidence breaks. The delay you're seeing right now isn't mercy. It's the final warning. If you want to understand these shifts before they become obvious, if you want context instead of noise, structure instead of speculation, this is exactly what we do here. Welcome to Finance Archives. This channel exists to document the patterns markets repeat, the risks that get ignored, and the signals that matter before they show up in the headlines. If this perspective helped you see the system differently, subscribe to Finance Archives. Stay ahead of the narrative, and pay attention while there's still time. Because when the calm finally breaks, the archive will already have the answers.